Hello, everyone. In this video, we are going to talk about efficiency ratios. So in this lecture, we're going to cover working capital management and the various efficiency ratios that determine how effective a company is at managing their working capital management. In addition, we will also be covering the cash conversion cycle. So let's begin with working capital management and what it is. So the goal is to maximize the efficiency operations. And the way a company can tell if they are maximizing their efficiency is by looking at their inventory, accounts receivable, and accounts payable, which can help a company to improve its earnings and profits. So in order to figure out the efficiency ratios and the working capital management efficiency, you need to evaluate and calculate efficient ratios and then calculate the cash conversion cycle. So to relate this to your personal life, this is your individual cost of living, right? You need to collect money that is owed to you, your paycheck, in order for you to cover your day-to-day expenses and bills. So this is the same idea behind working capital management as it relates to your personal life. So here's the working capital life cycle. And as you can see, it deals with purchases, production, raw material inventory, finished goods, accounts receivable, as I just mentioned to you. Purchases, which are accounts payable, is going to answer the question, how long does it take a company to pay its bills, right? So you may have to purchase raw materials from a vendor and you want to know how long does it take us to pay those vendors back. With inventory, you're answering the question, how long does it take a company to turn over its inventory, to sell its inventory, which is an important metric when you have a business. And then for the collection part of it is your accounts receivable. And that answers the question of how long does it take a company to receive payments from invoices that were sent out to either vendors or customers. So the information that you need to calculate the working capital management of a company, which is conducting the efficiency ratios, you need information from the income statement, the current year revenue and previous year, and you need the current year of cost of goods sold or cost of revenue and the previous year as well. On the balance sheet, you're going to need 3 years worth of accounts receivable, inventory, and accounts payable. So these efficiency ratios, what they tell you is it measures the company's ability to use its assets to generate income. For accounts receivable, which is money that is owed to the company from vendors or customers, you want a higher number because that indicates a company can collect what is owed to them in a shorter amount of time. Inventory turnover, this also indicates how quickly a company can sell off its inventory. A lower inventory turnover can indicate a problem with sales. It can mean that inventory is sitting on the shelf for a longer amount of time, or you're overstocking, and that can tell the company, well, if we're not selling our inventory in X amount of time, maybe we don't need to keep so much in inventory. And accounts payable turnover, high or low could indicate different things, right? If you have a high accounts payable turnover, that means the company, excuse me, the company is taking its time to pay off its suppliers and vendors. And with that, it could be a good thing because they can use that money to fund operations because they're holding on to that money that is owed out a little bit longer. If it's a low payable turnover, that can indicate that a company is very efficient with paying its vendors. But keep in mind, with accounts payable turnover, lots of times companies set up payment terms with their vendors. It could be net 30 days, it could be net 15 days, net 90 days. So for example, if you go to the doctor and you receive a bill, it may indicate net 30 days, which means they want to receive their payments within 30 days. So with each company, they can have different contracts set up with different vendors, which can have an impact on the accounts payable turnover. So first, we're going to discuss inventory turnover, which is how often a company turns over its inventory in a year and in days. As I said earlier, the information comes from the income statement and the balance sheet. And typically, you want to analyze 2 years' worth of data for a comparison. The calculation is cost of goods sold, which comes from the income statement, divided by average inventory, and that equates to the inventory turnover. Then when you want to get into days in inventory, it's the average inventory calculation is the current year plus the previous year divided by 2 to give you the average inventory, and I'm going to show you an example of that. So for this example of efficiency ratios, we're going to use Amazon as the company, and this is Amazon's income statement, right? So for the inventory turnover, you need the cost of sales from the income statement. And when you download any data, it will usually give you 3 years worth of data on the income statement. And then on the balance sheet, we want to look at inventories. So now when you download data for a company, it will typically give you only 2 years worth of data. So you need to go back and you need to select the previous year's data because you need 3 years worth of data to figure out the inventory turnover for a company. So as you can see on the screen, I've already done that and I've added in the 2018 number. So here's our calculation for inventory turnover, step 1. I have the current year and I have the previous year, and I need my cost of goods sold and I need my average inventory. So for my cost of goods sold, I'm going to go to the Amazon income statement and I'm going to grab the 233,307 and put that into my inventory turnover spreadsheet. And I'm going to take the 2019 number and I'm going to put that into the inventory turnover spreadsheet. So here's where we get a little confusing. For inventory, remember, we need the average for 2020 and we need the average for 2019. So in order to arrive at the average for 2019, you need that 3rd year's worth of data. So to come up with the average inventory for 2020, I take 2020's inventory, 2019's inventory, and I divide that by 2. Or I use the average function in Excel, and that gives me 22,146. And that's the number that I insert for 2020. Then for 2019, I take 2019's inventory, 2018's inventory, divide that by 2 or use the average function, and I come up with 18,836, and that's what I insert for the average inventory of 2019. So then when all is said and done, I take the cost of goods sold, I divide that by the average inventory, and these are the numbers that I come up with. And so what does this mean? So this is telling me that Amazon is able to turn over its inventory almost 11 times a year. And if I look at the previous year, which was at almost 9 times a year, this is a little bit quicker, right? Wouldn't you say, right? So it's improving, and it looks like they've become a little more efficient with turning over their inventory. Now I want to calculate the days in inventory. How many days on average does it take Amazon to turn over its inventory. The previous slide was a year, how many times in a year. This is now going to talk about the days it takes them to turn over their inventory. So what you will do is you take the annual inventory that you've just calculated, and right next to that, you're going to set up another area for days. And for days in a year, you're going to use 365. And that's something that the US uses. In most other countries, you use 360. If you wanted to find out in a quarter, you would use 90 days, right? So we're calculating how many times in a year how many times in days does Amazon turn over its inventory. Therefore, we're using 365. So I grabbed the results from part 1 of my annual turnover, and I put that into the days calculation. And I grabbed my results from 2019, and I grabbed those results and I put them here, and then I do my division. And I come up with 34.65 versus 41.53. So what is this telling us? This is telling us it takes Amazon an average of 34, almost 35 days to turn over its inventory, whereas in 2019, it was 41 days to turn over its inventory. Next, we're going to talk about accounts receivable turnover, and this is how often a company collects payments from vendors and customers in a year and in days. And again, it uses the information from the income statement and balance sheet. We need 2 years worth of data from the income statement, and we need 3 years worth of data from the balance sheet. And again, this is going to use, instead of cost of revenue or cost of goods sold, the receivables turnover uses revenue from the income statement. So I take the information from the income statement and I grab that number and I put it into the accounts receivable spreadsheet. And I take 2019 and I put that into the accounts receivable spreadsheet. Now I want to know the average for the year. So again, I take 2020 plus 2020's number plus 2019's number, divide that by 2, and here is my average. And I take that average number and I add that to average receivables. For 2019, I take the 2019 average of 2816, the average of 2018 of 16677, do my calculation over here in the corner, and I grab that number and insert it into the average receivables. And then I conduct the calculations. I have my revenue divided by my average receivables, which comes up to 17 times a year that the accounts receivable for Amazon, and in 2019, it was 14.96. So what does this mean? This means that Amazon is receiving payments on average 17 times in a year, which is definitely more than in the previous year. And again, it looks like Amazon has done some things to improve receiving money that is owed to them by customers and vendors. Now to do the days sales outstanding, which is the receivables turnover. It's called days sales outstanding, DSO. So again, I have my year and I have my days on this side. I'm using 365. I'm grabbing the results from the receivables turnover and putting that into the days spreadsheet area. I'm grabbing 1496 and I'm pulling that over into 2019. And I do the calculation of 365 divided by 1702, which comes out to 2144 versus 2439. So again, what does this mean? This means that receiving payments from vendors Amazon is able to receive payments on average every 21 days in 2020, which it was at 24.39 in the previous year. So that again indicates that there's been an improvement. Accounts payable turnover is how often does a company pay its bills in a year and in days. Income statement is used, balance sheet is used, 2 years worth of data from the income statement, 3 years worth of data from the balance sheet. So from the Amazon income statement, the calculation is cost of goods sold divided by accounts payable. So from the income statement, I'm going to grab cost of goods sold, and I'm going to put that number down here, and I'm going to take the 2019 number of cost of goods sold and put that down here. Then to arrive at my averages, I go to the balance sheet. I look at my accounts payable for 3 years. I take 2020 plus 2019, divide that by 2, and I come up with 59,861, and I plug that number in the accounts payable section. For 2019's average, I take 2019 plus 2018, divide that by 2, which equals 42,688, and I bring that number down here. And then I do the calculation, cost of goods sold divided by accounts payable. So as you can see in 2020, accounts payable turnover was 3.90, meaning almost 4 times a year Amazon makes payments to its vendors, which was pretty close to 2019. So let's find out what this means. So first, what we're going to do is the calculation for the days in inventory. So again, remember, you take the results of your payables turnover and you insert that number into the days payables turnover, DPO. And you take from 2019, the 388, you plug that in here. You take the 365, you divide it by the 390, and it comes out to 93.65. So on average, it would take Amazon 93.65 days to pay its vendors, little over 3 months. And it's a slight improvement from 2020 to 2019. So you can turn around and say that Amazon is not good at paying its vendors, right? Because it's taking them 90 days. But remember, this could be something that's intentional because Amazon may have contracts in place with their vendors that are, payment terms are net 90 days or net 30 or net 120. And then when that averages out, maybe it's, 90 days on average. So, the days payable outstanding, you really have to look at this number to see, to determine, is this really good or is this really bad? And again, this is what we've just gone over. So next, what you want to do is you want to look at all of these ratios that you've just calculated, and you want to figure out the cash conversion cycle. And the way that you do this is the calculation as indicated here, and I'm using the acronyms DII plus DSO minus DPO, days in inventory, days sales outstanding, days payable outstanding equals your cash conversion cycle. So I take the days in inventory from 2020 and from 2019, and I just plug them into this little spreadsheet here. And I take inventory plus days sales outstanding, and I minus out days payable outstanding, and it comes out to a negative number for both years. So a negative number, some may say, well, wow, that's not good, but a negative CCC can be good because it's actually an interest-free way for a company to finance its operations, right? So they're collecting payments that are due from their vendors fairly quickly. They're turning over their inventory fairly quickly, but they're not paying their vendors quickly. So they're actually holding on to that money. and they're borrowing from their suppliers to finance their operations. So that's one way that you can look at the cash conversion cycle. So here's what we've learned in this lecture, that working capital management is a way for a company to measure its efficiency in receiving payments, selling off its inventory, and paying its vendors. We've just gone through 6 efficiency ratios, and with those 6 efficiency ratios, we've arrived at a cash conversion cycle, which determines the overall efficiency of a company with its working capital management.